Three approaches to pricing. There are three main approaches to price setting. We'll discuss how they differ, when you should use them, and what are the pros and cons of every approach. So let's go through them. The first approach is called cost-plus pricing, and most likely it was the first one to be used by people. For centuries, it was dominating the way people were pricing products. In this approach, you first of all calculate the cost of producing, delivering, and marketing the product. Then you assume certain margin per product or as a percentage and use those two information combined to set the price. We'll have a look at the example later on, but basically here you use the cost as the base for your calculations. Cost plus pricing was very popular in the 19th century and also in the first half of the 20th century when mass production became a thing. At some point, firms have discovered that by applying cost plus pricing, they leave a lot of money on the table. The product that you sell may be worth much more to your customer than what you got by applying cost plus pricing. Therefore, they have developed a new approach, which is called value-based pricing. The underlying logic for this method, value-based pricing, is to try to guess the value that the product has for the customer and to price the product using this as a starting point. This trend of applying the value-based pricing became an important growth engine for consumer goods producers, especially fast-moving consumer goods and slow-moving consumer goods. In the late 20th century, the value-based pricing became all the rage. It became the only reasonable way to approach pricing. What we have discovered as we had more and more data is that you can actually estimate the value, not for the whole population, but even for specific segments of customers. So here, actually, the value-based pricing could target specific segment and not the whole population with one price. With big data, you can do it even for individual customer. Now, in value-based pricing, we, in a sense, disregard the costs altogether. This is not really that important for you when you set the price using this approach. In value-based pricing, most of all, you estimate the value the product generates to your customer, and this is usually done in money. This value can be different for different segments, and it determines the price for the product and service. Therefore, we can have a situation that the price we set for different segments may differ. So one customer may be paying more because he has bigger value coming from the product, and the other may be paying less. The third approach, called competition-based pricing, is used quite often on crowded, mature markets. It may also be used as a supporting way to determine the price of a product. In competition-based pricing, the main point of reference is obviously the prices of products set by your competitors. In this approach, we look at the prices of the products which are already in the market, and then we have to decide how we price our product. Do we price it below, above, or at the same level as the competition? Now, let's have a look at a short example that will show you in practice how those three approaches differ. So let's imagine that we have the following elements. So for cost plus pricing, obviously we have to have a cost of the product, which is 10. Then we also have the margin per product. We set it to be 4. In this way, we get a sum of those two elements and the price is set to be 14. Now, for value-based pricing, obviously we need to know what is the value of the product or the service to our customer. So let's say that through the survey and research, we discovered that this is 40. And we decided to set the price roughly at the level of the value that the customer gets from our product. So this would mean that using the value-based pricing, we would have to price our product at around 40. And finally, in competition, we have to obviously know what is the competitor's price. So let's say it's 20. This would suggest that our competition-based pricing would be 20. So as you can see, using different approaches for the very same product, we get different prices. And let's just present it on the graph. So the cost is 10. If we use the cost plus price, the price of the product would be 14. If we look at the value, then it would be 40. But when we look at the competition, we actually would set it at 20. In practice, you would be using a mix of those elements. So it can be a mix of cost plus pricing and competition-based pricing. So this would be usually for the commodity. Whereas for consumer goods, you would look at the value-based price and also competition-based price. So that's in short when it comes to the comparison of those three methods. Now we'll go a little bit deeper into value-based pricing.